Great. Well, welcome everybody. Thanks for joining in. This panel really will be looking at the late stage market, IPOs. Obviously, it's been a pretty interesting environment given COVID. We've seen companies scrambling for cash in some cases, some others that are in stronger positions still being able to raise at quite nice premiums to their past rounds. But really, I'm excited to hear from these panelists we have today. They're all very experienced investors and have a lot of thoughts on where we are in late stage markets. So without further ado, I'd let them just do some quick introductions and then we can get into it. Maybe Jay, can you start?
Sure. Hey guys, great to be here. Good morning. I'm Jay Das. I'm one of the MDs and president at Sapphire Ventures, growth stage fund with about $4.5 billion under management. Some of my investments have been like Alteryx and MuleSoft, and currently in companies like ThoughtSpot and DataRobot.
Guys, I'm Abhishek Sood. I'm a managing director with AB and its private business, AB Private Credit. Lead our investments in growth stage capital, where we do up to $30 million equity investments, 150 credit, as well as structured investments. Fundamentally mid to late stage investors focused on enterprise B2B. Fortunate to have co-invested with Jay over the last year in deals such as DataRobot and Netscope, as well as Punch. And then on the credit side, we've done investments such as Fuse and Degree, put in 115 million in Fuse last year. So very good to be here.
And I'm Gene Ramirez. I'm the managing director in the investment banking group at BTIG. We're a growth-focused investment bank with 18 offices around the world. Very active in not only the public markets but private markets. Some of the transactions we've worked on is we were underwriters in Cloudflare, CrowdStrike, and a number of other leading technology companies. And we also have other industry groups where we're very active, from healthcare, fintech, et cetera.
Great. And I never introduced myself. I'm Miles Kruppa. I'm a venture capital reporter for the Financial Times in San Francisco. Great. Well, I think, for me at least, one of the deals, the sort of private deals of this crisis has been Airbnbs, right? Obviously, one of the largest privately held marketplace companies doing a sort of structured debt deal with equity warrants. They took quite a haircut on those warrants. But for me, that deal feels years in the past now, not even weeks. So I'm interested to hear from Jay and Abhishek and Gene, what are companies doing now, right? If I'm a company looking for capital, maybe I have 100 million in revenues, I'm late stage pre-IPO, what are my options? What are companies evaluating? What are you telling your portfolio companies to think about?
Yeah, I can start. Look, if you have 100 million in revenue and you're growing above 50%, you'll probably have an investor pinging you every minute, if not, every second, right? People are investing. We have done 2 deals. We actually have 2 term sheets out. And I can see like all my portfolio companies that are doing well and growing, they're all getting pinged by investors left and right. And if you look at any of the deal kind of emails that come out every day, the number of new deals being announced hasn't gone down. It has actually increased. I was surprised for the number of deals that were announced today. So yeah, I think it's very active. Like if you have a good business that's growing, I don't think you'll have any problems raising money.
Yeah, to add, look, we took a look at Airbnb. Now we do more enterprise. So, we decided not to pursue Airbnb. But I would echo what Jay is saying. Now, of course, Jay is a phenomenal investor, friend, and mentor. So, he gets to see all the best companies. But I will also say that there is a continuum, right? If you are a good business, you certainly have a lot of capital raising options. However, I will say that a lot of the venture growth guys have taken a pretty serious look at their portfolios, and whether it's an 80-20 rule or a 50-50 rule, they have decided that this is the top quartile, or these are the 50 to 60% of the companies that we're going to put our weight behind. And then, unfortunately, if you come out in the residual 20 to 40%, it has become a lot more difficult, right? I mean, typically, if you look at enterprise investing, by the time you reach growth, the number 1, 2, 3 players raise capital, and then things fall apart. But over the last decade or so, the number 6 player in a category was also oftentimes raising because there was so much supply of capital. That certainly changed. So, what we are seeing is if you have capital, if you are doing well, you will raise. Valuations have toggled down. There is more structure, even on the standalone equity deals. And interestingly for us, given we do have an ability to do credit, we're seeing a lot more demand for our structured or credit solutions, just because companies need to grow into the valuations at which they've raised good companies. And then I will say that this is also an environment where you will see some companies just die out, unfortunately, right? I mean, it is a market where some companies are struggling to raise capital, whether it's equity or debt, and and the term sheets that we see for some of those deals are such punitive that we don't do those kind of deals. But if you're not in the top quartile of performance, it's become a lot more difficult.
Yeah, let me kind of take a different angle as well, because I think Jay and Abhishek highlighted some of the things that they're seeing. But I think number one, it's really centered around what is COVID-19's impact on the U.S. economy, not only the near but the long term. Since we're talking about late stage sort of marketplaces, I think those companies that you've seen this incredible convergence, not only from cloud SaaS software, which I know Jay is very focused on, to machine learning, smart IoT data, and then also the ability to work anywhere. Those type of business models have been very attractive to investors based on the sort of we call this the coronavirus economy. So I think for those companies, coupled with the fact that if we had the discussion 6-7 weeks ago, where we have never thought the public markets were where they're at today, has been, I think, beneficial for a lot of those companies in raising capital currently. So I would say, there's really 3 key options: equity, loans, or convertible debt. Pretty straightforward from that perspective. If you're raising debt, obviously the credit bar is really high, or it's higher. You'll have to detail what the market disruption, if any, has had on your business. And then pricing, as Abhishek has mentioned, may be higher, and the structures in terms may be tighter. So that's sort of high level how we're viewing the current landscape.
Right.
So one other thing, just let me add, I would say is that especially if you are a software company, a SaaS company with recurring revenues, there is one other option, right? Because you have a recurring revenue, maybe your revenues might go down because some people might churn off, but you can right size the business to get to cash flow break even. So that is always the option. Like, if you're an Airbnb or something that is very much of a transaction oriented business, yeah, it's probably hard to do. But if you have 100 million in revenues, there is always that option where, you buckle down and just get to cash flow break even with whatever you have and not raise any money.
Right.
Yeah, no, that's a very good point. We've seen companies toggle down growth, take advantage of the operating leverage that these enterprise software businesses have, and say, look, we'll just a lot of good companies have just said we'll extend our cash runway from 12 to 24 months, dial down growth, and then toggle it up again as markets correct.
Right. And we've obviously seen a large run up in public tech stocks recently. Some big software names making big gains. Has this had any effect on the sort of psychology, maybe companies looking to go public opportunistically, or just even having more negotiating leverage with their investors? I mean, what are you seeing?
Look, we are seeing kind of the valuations, like as Abhishek said, for the really good companies, I think the haves, their valuations are still nosebleed. We have seen some deals that were done at the multiples, which is great. We think it's crazy, but then you look at the public markets. Some of these companies are trading at I think Zoom is still trading at like 40 times, 40x. I think Kruppa is up there. I don't know who else. So when you look at it and you see the public companies are out there, and I think just like the public markets, the private investors, they're all looking at what it's going to look like in 2021 and 2022. And if they see a company that is growing well, that is in a place that the market is going to, people are still paying up for them.
Yeah, I mean, to add to what Jay is saying, Miles, think about it. GDP is down 15, 18%. Tech is one of the growth spots. I mean, a lot of what I would say second, third, fourth tier companies are not growing. They've either dialed down growth. But if you see a company that's growing north of 30, 40% at scale in this market with good unit economics, you would probably pay a premium. Now, I will say we were all hoping for the center of gravity to move a little bit more towards investors. And I think the dial back, Jay, correct me if you disagree, has happened. Because of the way the public markets have rallied, it's been a lot more short-lived, with the Fed pretty much subsidizing everything and, center, it's become, we haven't seen that correction as much in privates as perhaps we were hoping for.
Although I would say even in April, we saw some deals that got done at these valuations, which we thought, were crazy, right? But it got done, which would be, really, really high, even in, times pre-COVID times.
Yeah. Right. The only thing I would mention from an IPO perspective is, and I know a lot of investors focus on, which you tend to have to, the volatility index, which we call the VIX. So at the close of business on Monday, the VIX was below 35, which is the lowest point it's been since early March. Let's call it March 3rd or 4th. And the typical sort of scale that you look at to take companies public are, when the VIX is above 20 to 25, it can get negatively impacted in terms of pricing an IPO. If it's above 40, it's almost, I would dare say, it's not impossible, but it's extremely difficult. But we're starting with the stock market recovery. We're starting to see some stability in the IPO market, and we have seen about 6, 7 companies that have filed confidentially over the last 2 weeks. We can't mention them here, but it's been an interesting sort of data point. And I think what you're going to see more is those IPOs going to market this year are going to be larger than smaller, because in a volatile market, liquidity is critical. Hence the larger nature of these type of businesses.
By the way, Gene, Zoom info went out today, right? And
yeah.
It's kind of, I think it's trading. Yeah. I don't know how it's trading.
They've started their roadshow. So in 2 weeks, that's one to look out for.
Yeah, next Wednesday, I believe they price.
Next Wednesday.
Okay.
After the market.
Yeah. Gene, talking to public investors, have you seen their appetite change for growth companies because of COVID? Are they looking for anything different at this moment?
In terms of those going public, or those that are also crossover funds that are looking at private sort of direct investments?
Yeah, I guess both. They go kind of hand in hand.
Yeah, no, as I mentioned before, I think everybody has been really focused on those sort of coronavirus economy type companies, those that will do well during post this crisis, and everything from collaboration to you name it. I think those companies are top of mind, and so we've seen the late stage financing market slow down, but not to a detrimental level. I know we're going to touch upon M&A here in a moment, but I think quality of team, growth rates. I know on the marketplace side, typically investors are seeking where revenues are growing 3 to 5 times, sort of that high growth rate to get involved because of the scale that's needed, the network effect, and so forth.
Are those numbers still there given the business hit from COVID? Are you still seeing those kinds of growth numbers?
Well, I think for the top tier, we've seen those numbers sort of come down slightly, but I think for the remainder, it's clearly been impacted.
Right. Jay, Abhishek, do you have any thoughts on that?
I would echo what Jay said earlier. I think, look, even the top companies are being more judicious. I mean, probably a year, 2 years back, growth was the single largest determinant of public or private market valuations. I think companies, and I think it's good for the ecosystem overall, have dialed down unprofitable growth. So there's a lot more focus on cash burn. Even in the top companies, we are co-investors in some really good companies. We would like to hope and believe they're really good companies. And, we know how razor focused They are in, these companies have built 15 different scenarios to manage through every possible. You never thought, that would happen in mid to late stage venture normal environment. So I think the focus is a lot more on profitable growth, where you're backing a good company in a good secular tailwind. You are still seeing growth, but it's a lot more, preserve cash, grow, but don't grow at all costs. And I do think, an increasing determinant when we're looking at companies, certainly on the structured credit side, but perhaps even on the equity side, is look, what is the capital efficiency of this business, and how much runway does the business have, and how has management actually pivoted, proactively to COVID versus like the board saying do a riff or whatever else.
Right. I think that's an interesting segue. There's probably going to be some strategic acquirers looking at companies right now, maybe thinking they can get a deal. Maybe that's the wrong thought. But I'm curious if you're getting any inbounds, Jay, especially from big acquirers, or is private equity sort of coming back from the dead a little bit? I know buyouts have been pretty stagnant for the past few months, but what's the thinking now?
I think we are definitely seeing a lot of the PE shops being very, very, very active, right? They have huge amount of dry powder. They've all raised a lot of money. So they're all kind of trying to, go after some of these assets. And I think, unfortunately, some of the PE shops, from a venture investor perspective, are still looking to get a good deal. Right. And, a lot of companies now, right in March and April, kind of right-size themselves. And they're like, hey, we don't need to sell, unless we get the price. And when you look at the public markets, there is really no need to sell. So I think there is a mismatch in the ask and the bid. And I will see how this plays out. But, I think the PE guys want to act on these companies. But I think the existing investors don't want to sell.
Yeah,
I would put it into two buckets. I would agree with Jay. I think, look, the best companies typically find their own exits. I mean, you can't go and acquire them for a bargain. You just can't. Look at companies like Looker, and we would like to hope companies like Netscope, DataRobot, etc., are in that league where they are category-defining companies. That said, look, we do have companies in our portfolio which are actually getting positive tailwinds from COVID. If you're in the communication, security space, etc., you're benefiting a lot. And we have seen inbounds from both financials and strategics. Strategic inbounds oftentimes make more sense because they are more comfortable paying high multiples, particularly given the rebound in public markets. That said, I do believe there are a large number of strategic players, the Facebooks, Googles, Amazons, Apples are sitting on pretty significant net cash positions. And like you saw in the case of Zoox, etc., when you come to a tier of companies that will perhaps struggle to raise capital, you will see a lot of increased M&A activity to buy IP, to buy technology, because they think they can probably put it. So I think from the strategic perspective, we will, you will see a lot more opportunistic M&A versus, perhaps what you would have seen, in Q1 or late last year.
Yeah. I think from a M&A perspective, we've seen Microsoft very active. I mean, they just purchased or acquired Softomotive. Facebook bought an animated image search engine in Southern California. Apple's been active. Some of these are not announced, but small, acquisitions that are very strategic in nature. In fact, on the private equity side, consistently, if you look over the last 3 or 4 years, on the buyout front, there's been literally $2 to $3 billion transactions, every month, and you haven't seen that in the last 2-3 months. Not one sort of $1 billion plus transaction. And what's been interesting since the start of April, you've seen some of these larger players, everyone from Great Hill and Charles Bank, where they invested $535 million in Wayfair, or Silver Lake and Apollo investing $1.1 billion in Expedia, or Francisco Partners investing $225 million in Eventbrite. they've taken these minority interests in these public companies. So everyone's sort of seeking alpha in different ways to kind of figure out how to generate a nice internal rate of return. So I think we're hopeful that the M&A market will come back strong the second half of the year, and we'll wait and see.
Mm-hmm. And one thing, Gene, it seems to me that in the market, the public markets, the biggest activity has been around SPACs.
Yes.
Where all of right.
Yep.
It's like 16 billion or something.
Mm-hmm.
Like
it's
Virgin, Galactic, DraftKings, Nikola.
Yeah. That's a good. Gene, are companies really seriously considering SPACs as an outlet?
Absolutely. And I don't want to put a plug for BTIG, but we're actually one of the top underwriters and advisors in the SPAC market, and so there you go. So we've been very active in that market, and what you've seen in that particular market is not only the financial sponsors across different sort of private equity shops to well-known executives who are raising 200, 300, 40 million, 600 million, and you name it. It's also attracted a number of institutional investors who are investing in these blank check companies. And I think that's brought a lot of attention to investors such as Jay or Abhishek, who are looking, as well as other investors, that this may be a nice alternative to a traditional IPO. It's a very transparent process, and it's been one that's it's an alternative asset class for a number of not only SPAC sponsors, but also for investors. So absolutely, I mean, if you look at DraftKings, that's been a highly successful transaction, and there's a number of other case studies that are also attractive.
Right. Well, I think we're supposed to leave a few minutes for questions, but I'm not seeing any right now. Do please type in a question if you have it. I have, I guess, one thought we can leave on, which is, it seems about 4 or 5 years ago, people were sort of predicting a valuation reset, right? It felt similar to when COVID hit. And I think there's still some uncertainty around how things will shake out, whether there's a longer tail to this. I mean, if you had to sort of put on your look into your crystal ball, are we actually going to see a significant valuation reset sort of across the board for late stage companies, or will most come out of this fine?
We have talked about this. I think there is some valuation reset in I think, which are very directly connected to consumer spend. So, like an Airbnb or, something like that, they have to go raise debt with structure and things like that, because it's very consumer focused or travel focused, consumer related. Maybe, companies that are focused on the restaurant space. But, if you're focused on something that people think there's a lot of tailwind, and even in the new normal, or once we come out of it, people are going to be using in it, something crowd infrastructure, like collaboration. I don't think there's any valuation reset, because people are just betting that, these things are just going to keep growing, and that's how we are going to work and develop software in the future. And, and we talk about tech here all the time. If you look at some of the other stocks, it has been hit pretty hard, right? Like, I think somebody told me United is trading at like a 4 billion market cap. And that is probably less than the value of the planes they own, right? So if you look at some of these other industries, like Marriott is like a $20 billion, like really small number that they have fallen to. So it's not like stocks have not been hit. It's just we are in this area where it's all about technology, and some of the technology is being used a lot given where we are right now, and that is why the stocks are all doing well.
Yeah.
Great.
Jay, you just reminded me of a data point, which is Zoom's market cap is greater than all the U.S. airlines market caps combined.
Yeah, that's right.
Okay, here's an interesting question. We have 1 minute maybe to answer this. What role has the Fed played on the VC community here? Has the liquidity injection had a trickle-down effect?
I mean, I think each of us should opine, but generally, look, the Fed injecting liquidity has showed up. There was a divot that was created in the economy. They've kind of filled it up. They have showed up a fair amount of capital from a demand perspective. I think, to be fair, almost all venture-backed companies that we know and most VCs have taken, call it the moral high or the ground that, look, we are going to invest in this. So very few companies have tried to, in our portfolio, and most of the friends we work with, like Jay, et cetera, have tried to take advantage of the PPP loans. They're just saying that, look, we don't want to face the scrutiny. Even though we are all burning money, we'll just, try and preserve capital. But yes, this would have been a lot worse and unimaginably worse had the Fed not intervened to the extent they have, I think, for all of us collectively.
But I think actually it's not the liquidity that has helped as much as keeping the interest rates so low.
Yeah.
Because since the interest rates are so low, people who have to buy stock to get growth, right? And the only stock that is buying growth is tech stocks. And that is a reason there is so much demand and these stocks are trading at this kind of insane valuation. And based on that, yes, it has made it difficult for us to get, a deal or, a great deal.
Right.
Because valuations haven't really come down.
Great.
Yeah,
Well, I think we have to wrap it up, or else the organizers are going to get mad at me. But thank you, everybody, and thanks everybody for watching. Feel free to shoot any other questions my way, and I'll try to get to them.
Thank you.
Thank you.
Thank you.
Thanks, Miles.
Thank you.
Thanks, everybody.
Thanks.